Hey everybody, welcome to this free edition of our Trader Use Group, a weekly roundup for the trading week ending March 17th, 2023. I'm Preston Brent. Thanks for tuning in. Our theme this week is the Fed's Conundrum, and boy, they got one. We'll talk about that in just 1 minute. But first, let's just take a look at where everything settled up this past week. Take a look at a couple of key numbers and just review a little bit about where I can see the markets going. If you look at the Dow and the Russell, both of them were down in the red for the week. Year to date, they're also in the red, and yet S&P and NASDAQ in the green for the year. NASDAQ had a great week this past week. You would think with volatility actually going up for the week that we would have had red across the board across all the weekly numbers for S&P and NASDAQ, but we didn't. The forward PE ratio for the S&P is at 17.93, just a bit higher than I think it should be. You can see the 10-year Treasury is all the way down to 3.39%. It's fallen a pretty good little bit. Earnings yield is at 5.62%. You can see the S&P dividend or S&P yield over the 10-year Treasury. Still a positive number. Real yield is still negative, meaning inflation still weighing on everybody, weighing on the markets. And the VIX closed the week 25.51. Last week was at 24.8. So the VIX moved up just a little bit this week to close a little bit higher. We're in the mid 20s now. Volatility and the volatility of volatility is staying high this week, as you would expect. You can see the best sector this week, technology, 5.66%, primarily because of the mega cap. The Amazons, the Apples, Microsofts of the world, strong balance sheets, a lot of cash. Those asset classes tend to be doing very well. The worst for the week is energy, down 6.85%. You traditionally see energy start to move lower on fears of a recession type of upcoming market event. Technology also year to date is the best too, 15.28%. Again, mostly guided by the mega cap tech. Energy is bringing up the rear, the same year to date, down 12%. Okay, so we're seeing some sectors doing well, others not doing so well. Financial and energy not doing well. Mega cap tech doing well. And after this Silicon Valley bank failure, we saw the Feds last weekend, the Feds, FDIC, and Treasury come in and pretty much make all the investors or the depositors rather whole. And then they announced that for the other banks too, First Republic and Signature Bank. But it still didn't do enough to move volatility down. There's still a big fear out there in the markets on what other potential regional banks can be affected by this move here. And members, Sunday evening, I'll go through a little bit more detail on what really caused SVB failure and, just my assessment on the risk going forward. And by midweek of this week, the Feds had injected about 300 billion more into banks to shore up their liquidity. We saw some banks get together like Morgan and JP Morgan, Morgan Stanley, and others put some money into SVB for 120 days. So they'll get it back, but they put it in to help SVB liquidity issues. So we'll see how all of this stuff shakes out. I still think it's going to be contained. I do not think it's going to move over and jump over to other sectors or other larger banks for that matter. But there's still that contagion risk, which is keeping volatility up a little bit higher than it should. And as I said with the 10-year Treasury, I mean, it's at 3.39%. Okay. That's the lowest level we've seen since February of this year. But the other thing that really is interesting, the Fed, their interest rates tend to follow the 2-year interest rates. And we saw the 2-year interest rates this week plunge over 74 basis points. That's huge. It moved down to 3.84%. That's the most we've seen in a 1-week move in the 2-year rates since the end of October 23rd, 1987, which, by the way, was right the same week of Black Monday. So we're getting a ton of volatility in the bond market and interest rates, and that is rolling over into the U.S. equity markets. Okay. Now, just to give you an idea, this week we get the Feds Wednesday at 2 o'clock Eastern Standard Time. We get their interest rate policy and this policy statement. But at 2:30, we're going to get Boom Boom Powell and what he's going to do and say. The futures market just over a week ago was pricing in a 40% chance of a 50 bips rate hike. And now they've taken that down to zero. And now the markets are saying there's about a 62% forecast of 25 bips, 38% that they stand pat. I believe what they will do is hike the rates 25 bips. That's what I would suggest they do. Because if they don't, it'll send the wrong signals to the marketplace. But either way, it's going to keep volatility bid. It's going to keep it up this week as we're going into the Feds. And then we should probably get some more statements. In fact, we call her Aunt B, but that's Janet Yellen. She's speaking to the Senate Banking Committee or the Finance Committee on Wednesday to address Biden's budget. And I'm sure questions are going to come up on the bank. So let's see how she responds. She didn't do that well this past week when they were asking her questions on it. So hopefully she's got her answers down a little bit tighter this week. Okay. Now, if we come over and we look at Europe, you can see everybody was in the red in Europe, down pretty handily. Year to date, they're nice, solid in the green. The NASDAQ here in the U.S. is leading the way now. It was the CAC 40, DAX, and Euro stocks, all of them up double digits. They've fallen down after this week. The FTSE's in the red, not only weekly, but year to date, okay? The ECB raised their rates by 50 basis points this past week to 3%. Now, they said they were going to do it, but Christine Queen B. Lagarde, who runs the ECB, basically said they're going to now be data dependent going forward. So they didn't offer any guidance. They just going to take a look at the data. Okay. And one of the other things they did was they put their average inflation at 5.3% this year. And they moved it down to 2.1% all the way out to 2025. I mean, any kind of prognostication going more than 6 months, I think, is very suspect. I haven't seen central banks do very well in their forecast. But that's what they're saying. So net, they would expect inflation to go down, and so would we. So that's kind of what we're seeing here over in Europe. Meanwhile, the growth for Europe this year was revised a little bit higher to 1%, and that kind of reflecting lower energy prices. I guess they had a warmer than normal winter, and their economy's resilience to the challenges that they're getting from the overflow from the Ukraine Russian war that's going on there. Meanwhile, over in Great Britain or the UK, jobless rates are kind of unchanged, but they're at a record low at 3.7%, in Q4. So those numbers are just coming out. So that looks pretty good as well. Now, if we move over to the Asian markets, you can see the Nikkei was down for the week, up year to date. Same thing with China. Hang Seng is in the red year to date. In Japan, the banks there are really they're not going to have any contagion effect from the U.S. However, the Bank of Japan came out. They're meeting in April, but they're basically indicating to the markets that they're going to maintain their current market stimulus and monetary policy procedures. So that's supportive of the market. Okay. So that's a little bit about Japan. And then, of course, in Chinese markets, they had a pretty volatile week. You can see they were up just a little bit for the week. They're in the green year to date as well. So they're going to be more affected by global banking issues than, say, Japan would be. So that kind of offsets some of their optimism about their economic recovery coming out of zero COVID policy, right? But the People's Bank of China is continuing, as is Japan, to put stimulus in the economy. They cut their reserve requirements for banks by about 25 bips. So that means banks can be more free to lend. And on a positive note for Chinese real estate anyway, their home prices across 70 of China's largest cities rose by about 30 basis points in February. And that was up from a 1% or 10 basis point gain in January. So we're starting to see some stabilization in the Chinese real estate market, which, and as I said last year when it started coming up, there wouldn't be a contagion effect in the Chinese real estate market. It was mostly going to affect China. But that's what we're seeing right now in the markets. If I switch you over to the charts, let's just come over here and take a look at these charts real quick. I'm going to start with the S&P 500 E-mini futures, and you're going to see on the screen a daily chart. And looking at this chart, you can see just the choppy nature. I mean, once we hit our high on February 2nd, the S&P was up over 6% at 4208. We've just been nothing but a rocket ship down. And you can see here back on March 13th, just 5 days ago, calendar days ago, the markets actually moved into the red for the year below the 2022 closing price and then bounced back up. But until we can clear a couple of key hurdles here, we're still in the watch right now. And you can see the low price for the year is just slightly above a key fib node here at a 38% fib retracement. So I do believe that the markets, it's all going to depend on where the Feds are going to be going and any surprises. Just looking at the charts and take all the noise out, it would suggest that we may have a lower low here coming up over the next couple of 2 or 3 weeks. And just keep in mind, starting in April, and about 4 weeks, maybe 3 weeks from now, probably, we're going to start getting Q1 earnings. And they're already forecast to be a little over 9% lower than Q4. So it does not look good for the earnings in Q1. And most of the bet in the markets is that we're going to have either a soft recession or a limited or a mild recession in Q3, Q4 of next year, and then pulling out of it in 2024. All right. We'll know on the charts. It'll tell us kind of how we're doing this. But unless we get back up over 4,100, then this prior pivot high is going to serve as really a little bit more resistance for us as we're moving down. And you can see this bounce here off these lows. We kind of stuck it in my R1 zone here. This is the first level of support that I'm tracking. And then we kind of moved up to our S1 zone down here, and then up here our R1, our first level of resistance. And we're just chopping around here. I think the markets this year essentially are really going to go nowhere. We're going to see both up and down movement. I think this banking crisis will probably clear itself shortly. I think it's limited to just a few select banks. There may be a few others. I think the Feds, the FDIC, and the Treasury are going to address that. And then once that contagion effect has erased, then it's just going to be a focus on earnings and where the Fed interest rate policy is going to go. My bet is the Feds are going to hike the rates 25 basis points and then indicate a potential pause in order. They're going to say they are seeing inflation coming down, and then with the deflationary move that we're seeing in banks, because remember, bank liquidity starts to dry up, then lending starts to dry up. And when lending starts to dry up or get more restrictive, then businesses across the US having less money have less growth potential, which then affects the overall economy. And all of this tends to be deflationary. So I see some of all of these things working their magic here. But I just think Boom Boom Powell, Jerome Powell, we call him Boom Boom Powell, he's in a conundrum because he's got to address the interest rate issue, but he doesn't want to tip the banks into a worse condition with higher interest rates. But I believe he's probably going to be put in a position of having to hike at least 25 basis points and then indicate to some extent that we're going to slow it down and then take a look, and he's going to be very positive in his statement. So we'll see how he goes. If he were not to hike and then just leave it zero, I think it could send the wrong signal to the markets, meaning the market banking sector is worse condition than people think. And then with inflation as high as it is, he may have to come back and raise rates later. I don't think he wants to do that. And he's already committed to a 25 basis point rate hike essentially. So let's just see how all of this stuff shakes out. Either way, it's going to be a very interesting week for the markets for sure. And if we look at the FANG index, this is the ones that are doing very well. You can see here we're coming back up to the highs up here, right? I mean, we made a high. It was up 28%. Just the main stock. And this index is a custom index of Microsoft, Facebook, Apple, Google, and Amazon, right? I don't include in mine Netflix, but you've got Meta and Microsoft, Apple, Google, Amazon. You can see the big move here. So this tells me a lot of money is moving out of the banking sector. Clearly, a lot's moving into short-term T-bills and two-year Treasury notes. But you're also getting an equal amount of large money being allocated into the financial sector. I mean, into the technology mega cap sector, as you can see here. All right. It is setting up for potential diversion, so I think we may see a little bit of a pullback here on that, but it's just really interesting. And if we look at NASDAQ, which is the top 100 tech companies, it's very similar to FANG, right? Because FANG runs about 35 to almost 40% of the NASDAQ futures index. This is NASDAQ futures. You can see it's moving up near the highs here of almost 17.28% made on February 2nd of this year, okay? So just very strong. And then if we look at the general NASDAQ composite, which is everybody in NASDAQ, not quite as strong, but still showing some strength, right? But mega tech is where a lot of funds are flowing right now. Strong balance sheets, a lot of strong cash flow. So that's what we're seeing, okay? Meanwhile, if we come down here and look at the Dow, which is the one that's suffering the most, let me just see if I could find the Dow in here. I know it's in here somewhere. Here we go. Right here is down 425 points on Friday. You can see here that, and let me just adjust this right here. Hit a low on March 15th right here, down almost 4.9%, 4.8.5, so almost 4.9. You can see we're just sitting here chopping up and down railroad tracks with these candlesticks. And you can see the 50 EMA is over the 200, but it's working its way back down, or 50 SMA rather, is over the 200 moving average, and it's working its way back down. So we're going to see how this works. Now, the Dow, which was one of the strongest performers last year, is one of the weakest this year. It's only up 3.71% on February 14th, right, on Valentine's Day. And then it just gave it all up very quickly. So that's a little bit about what I'm seeing in these indexes. Now, if we step it out just a notch, what I want to do is show you the cash index, SPX, on a weekly basis. You can see all these big rallies, 12.5%, 516 points, almost 19% rally, 690 points almost. Here we had a 19.6% rally, 690 points, so 680, 690. You know, those are the rallies that we've had going back to the summer of last year. And now you can see we've come down and we moved back up above that downsloping trend line. We moved up over it, and then we came down and tested it, and then we moved back up. And we got, as you can see, a key fib node sitting here at 38.15, right? And that goes all the way from the pandemic low over here. So this is a strong support point here. And then you can see my target last year was reached. It came down to 34.91. This was my target. This is my longer term support S1 zone. Now, I've heard a lot of people on TV saying, are the bear market lows, which was on this date right here, back on November 10th of last year, or October 10th of last year, are those lows going to be breached if we start rolling over? If we move into a recession, they probably will be breached. Not sure yet. The key number near term for us is 3764.49. So let's say if we take that number out, that dramatically raises the odds that we're going to go lower. Now, we may not be a straight shot down. It may be choppy, but that's kind of what I'm seeing. We may have a bump up into the end of March, into the first week of April, giving us a little bit of a reprieve, and then Q1 earnings are going to come out with forward guidance, and that's going to roll us back over. And then you're going to see a revaluation of all equity markets, PE ratios coming down, earnings forecasts coming down, and that is kind of how I would see the markets rolling back down and challenging the bear market low that was made over here. Okay, so that's a little bit about what I'm seeing in some of the key indexes here. And then, of course, if we look at where are we here? If we look at this right here, you can see volatility. If we look at the back month vol futures, if you look at the skew, you can see here the way we ended on Friday. It's in a contango. right? So this is the March to April, and March volatility futures expire on Tuesday of this week. So it's comparing it to April. We're in a contango, which is normal. And if we go out and look at the 2-8 spread, that would be, I'm looking in this case, March and August. If we look at those spread, vol, you can see here, we moved into the red. So now we're comparing August, and what this is telling me is in a backwardation that the markets are forecasting, if not a recession, more downside later in the summer. At least that's the way the volatility futures are shaping up, which would kind of go in mine or hand in hand with what I suggested, which we'll have a little bit of a rally into the end of March. Maybe the markets will like what Boom Boom Powell has to say next Wednesday. An end of rally into March into the first week in April, and then once the earnings start coming out, we're going to start rolling over again. So volatility is just bouncing around all over the place, right? And it's very sensitive right now to market movement. And looking at the bond market, it has been the most volatile we've seen in decades. You can see the bonds. I've got to adjust my screen here, but it did move higher for the year. I mean, the high date now for bonds was on 316, which was this past Thursday, moving up a little bit over 6%. And it's just a lot of volatility in the bond market. Remember, when bonds move up, what do interest rates do? They move down. Okay. And if we look at the 10-year rate, you're going to see here on the 10-year interest rate, how they've moved down. They broached the 200 moving average. They're probably going to test this prior pivot low right here. And then we're going to see where they want to go. And a lot of this now is going to be determined by what the Feds are going to say this Wednesday. Can be real interesting to see how they shake it out. And of course, if we come down here and look at the dollar, well, the dollar is traditionally a flight to safety. But with rates coming down, interest rates coming down, it's moving the dollar back lower. Okay. And the one thing that it is helping is the yen. The yen tends to do much better in global panic, as you can see here. Here's the yen gapping up and moving up as the dollar gets worse. You can see the strength in the yen. The other thing that we're going to watch closely is I want to get back into a bullish long in the euro. You can see the euro very choppy here, right? I mean, just very choppy. We were in the green, now we're in the red, just big, huge bars here. I think Europe is going to probably fare better than the US in the markets. And I think the euro is probably going to fare better than the dollar this year as well. We got long the euro last year, made some great money on it. A lot of our members did very well. And we're going to be looking at that again. It's not a buy signal yet, but I'm just watching this closely. And then, of course, if we come down and look at gold, gold loves falling interest rates. Look at what gold did on Friday. Look at that move. I've got to adjust my screen here. 70 points higher on Friday. Unbelievable. These big candles here are almost just the opposite of what interest rates are doing. Dollar weaker, interest rates weaker, gold stronger. Very strong. And if I just zap it out just a little bit, you can see here where we are in this move here, up in this area here. And that was the high in 2022 at 2078. Now, I said, I want to be bullish gold this year. And the trigger was always moving up over the 50 EMA and then taking it higher. So we've been, at least for the way we've traded it, leaning bullish gold this year. So that's a little bit of what I'm seeing in the gold market. Okay. Now, another interesting chart is copper. Copper is a global chart. That means if global economy is slowing down, copper tends to go lower. And that would show where we're going here, right? Gold, more of a hedge against falling interest rates and a little bit of fear in the banking crisis. That's helping gold move up. But with copper, they call it Dr. Copper, it's moving lower. Okay. So, and then of course, if we get energy, oil is a precursor to potential recession. Look at the oil market. I mean, it gapped down. I got to change my settings on oil. We made new 2022 lows here in oil. I had thought that oil would kind of hold up here, but with the big drop in interest rates, with everybody seeking safety in bonds, short term Treasury T-bills or notes, and with the banking issue, then what the energy market is telling us is it's forecasting the likelihood of a recession just went up. In any recession, oil always goes down, right? Um, so that is something we got to watch very closely. It came down last year. My target was at 67.69. It finished at 66.34. So it took out 2022's low, and now it's made a new low here. So we're going to have to watch oil very closely. Nat gas, well, nat gas is just, that was a great trade for us. We traded it short. In fact, we got short nat gas back over here in June, July, or actually earlier here in June, July timeframe last year. And then there was another shorting opportunity here. When nat gas gets up into this range up here over 9, you just have to go short nat gas. It's a good trade, and it worked out well for everybody. All right, folks, that's pretty much what we're doing here. If you're not a member, I highly encourage you to come in. We got some good trades across the board, from commodities to some possible opportunities in the banking sector, as well as some other unique opportunities. I think they're going to surface themselves. Otherwise, members, I will see you Sunday evening. We'll go into detail on the Fed's actions and interest rates, and what we can expect as we move through the end of March and the Fed's policy statement next Wednesday. All right, everybody, have a great weekend. Enjoy March Madness for you basketball fans out there. Members, I'll see you Sunday evening. Take care, folks. Ciao.